Welcome to Old Mutual Multi-Manager's quarterly review. I'm Monene Watson, the CIO. It's been quite a quarter of extreme volatility. I mean, we're sitting now in September where things feel extremely volatile, but if we look at the quarter as a whole, it's been a tale of two halves. In some ways, the market bottomed in June, or that was the perception. We had a very strong rally, but that kind of became undone during the course of the quarter as inflation appeared to be more sticky and central banks seemed more resolved in terms of hiking rates. So as a result, we've had very poor performance from both local and global equity markets. Global bonds, which had started recovering, yields had come down, have shot up again. I suppose the one exception is the South African bond market, while it's also been volatile, has held up a lot better. The one place where there's been, some kind of strength is if you were invested in dollars, the dollars being the strongest performing currency, and not just against the rand and emerging markets, but against other currencies in general. So an extremely volatile environment. So I'm joined today by Izak Odendaal and Andreea Bunea, who are going to just share some light on the equity market as well as the macro. So Izak, just starting with the macro outlook. What are central banks doing in this environment? We've spoken for a long time about the risks being inflation and the impact it has on growth. But how are central banks responding, as we've seen this picture become clearer over the course of the quarter?
Yeah, I think the main message is they have responded forcefully. And the bottom line is that they have taken the view that they are prepared to sacrifice economic growth in order to get inflation down. Specifically in the case of the US Fed, and that's a central bank that we care about the most, because it sets the tone for everybody else. And as the Fed has hiked interest rates, and it's heading towards about 4% probably by the end of the year, above 4%, having started the year at 0%, that has put upward pressure on the dollar, as you mentioned, and it's basically forced all the other central banks into hiking as well. So we've seen the South African Reserve Bank, for instance, hiking interest rates during the quarter quite aggressively as well, even though South Africa doesn't have the same kind of inflation problem as the US. And elsewhere, you're also seeing central banks responding forcefully in Europe, in the UK, across emerging markets. It really has been the story of this quarter and indeed of the whole year, is this tremendous synchronized hiking cycle. And ultimately, that is going to push downward pressure on economic growth. There's no doubt. We need to see inflation coming down, specifically in the US, in order for that pressure to be relieved.
Thanks, Izak. Andreea, it's no surprise in this environment, that we've seen the weakness we have in not just global equity markets, but also in bond markets. Are there just some things that you would want to highlight in terms of the key things that have driven markets this year?
Thank you. It's interesting to note, global equity markets, as you mentioned, have had a horrid time so far this year to date. They're down close to 25% in US dollar terms, and close to about 6% of that having lost during the last quarter, during the third quarter. Growth stocks have actually felt the most of the pain of that sell-off. As we know, growth stocks have been the primary beneficiaries of the low interest rate environment that has persisted over the last decade. And coming into the new year, they were trading at very lofty valuations. Now, with a macroeconomic outlook background that Izak has painted, and in the high interest rate environment, we saw these growth stocks losing quite a lot, and they were down over 30% in US dollars. On the other hand, value stocks, for instance, having trading on relatively cheaper valuations, have only lost around 18% in US dollar terms. I think another interesting thing to highlight is amongst the main sectors, the energy sector was the only sector to deliver positive performance in this environment. And it doesn't come as a surprise given what oil prices have done over the last 12 months. However, some of those gains have been given up during the last few weeks, as downward pressure on oil as we saw downward pressure on oil prices on the back of high risk of global recession. coming to the fore. It's also interesting to know that, for instance, sectors such as utilities, pharmaceuticals, consumer staples have fared better in this current sell-off versus the broader market, and that's predominantly because of the more sort of defensive and more predictable nature of the earning streams that these type of companies tend to have. Another interesting thing, perhaps to note, is the strong US dollar, as you both mentioned already. And this has had a significant negative impact on returns from global equity markets outside the US, because those returns tend to be translated into US dollars as standard practice. So the stronger US dollar has definitely led to an uneven performance across global markets in general. Back home, the local equity market has certainly not been insulated, but it has fared better, with the capped SWIX losing around 8% year to date, and on the back of financials in general doing a lot better.
Thanks, Andreea, and we'll come back to where that kind of puts us from a valuation point of view. But before we move there, Izak, I just know, what are your thoughts on, what would make us feel more positive? What are the things we're looking out for at the moment? We're clearly at a point now where things are very negative, where central banks, are kind of single-minded in their approach. But what could change that dynamic?
Yeah, so I think the number one thing that needs to change is we need to have some good news on the inflation front. We need to see, especially in the US, we need to see inflation trending lower, not just headline inflation. As Andreea mentioned, the oil price is down quite a bit, so that's going to pull headline inflation down. But we need to see the core inflation that is much more centered on services, and that's much more linked to a strong labor market. We need to see that starting to cool down, and that will give central banks comfort, not necessarily to start cutting rates, but that they can maybe pause and kind of stop the rate hiking cycle. And I think that's the first thing. The second thing that would really help a lot, although I think is unlikely, is if we can have some sort of resolution in the war in Ukraine. Unfortunately, we seem to be going in the opposite direction. But that would help a lot if you can take some of that upward pressure of energy prices, food prices out of the system, as well as just the general risk aversion that it's caused among investors. And then I think the third thing that will help a lot is if you can, in China is still maintaining a zero COVID policy, and in all of this we tend to forget what's happening there. The Chinese economy is really, really weak as a result. And I think if they can get to a point where we're not locking down every time someone sneezes in China, I think that'll also help that economy stabilize, and that can be a positive contributor to overall global growth.
Thanks, Izak. So there's a lot of uncertainty, and I suppose from an investment point of view, the question we're always asking ourselves is, where's the margin of safety? And Andreas, if you can just talk to the valuations we're seeing on equity markets. As you said, markets have fallen a lot. How are we beginning to look at that margin of safety, looking at valuation, from an investment point of view?
No, great. So certainly when you look at valuations, we need to look at it not just in the context of the broader macroeconomic backdrop, but also in terms of what's been assumed or expected in those valuations. So to date, company earnings expectations have been downgraded to some extent, but not dramatically. So on the one hand, we've had company prices falling off dramatically on a year-to-date basis, as I mentioned. But on the other hand, and thereby sort of pricing in a higher risk of recessionary scenario. But on the other hand, company earnings expectations, as I mentioned, have not been downgraded to the same extent. So there's still a high level of optimism in terms of what these companies can potentially deliver, despite the macroeconomic backdrop having changed, during this time frame. So therefore, from a valuation perspective, global equity markets certainly look a lot more attractive than what they did in the beginning of the year. So if we look, for instance, at the forward P ratio of the MSCI Acqui World Index, which is the broader global equity market index, that's dropped from just over 18 times to in the beginning of the year to about 14 times more recently. And as I mentioned, that's been driven predominantly by that drop in prices, which is the numerator, but the denominator hasn't really changed much and has led to that relative cheapness. Where it stands at the moment at about 14 times, it's pretty much in line with this long-term average. So certainly looking more attractive from a valuation perspective than what it did in the beginning of the year. Having said that, within that valuation context, it's worth noting that those disparities in terms of relative valuations continue to exist. So the US market continues to trade on relatively more expensive compared to regions such as, for instance, Europe or emerging markets, and a little bit more expensive relative to its longer-term average. Having said that, if you take out the top 10 stocks in the US market, the rest of the market actually trades on valuations that are pretty much in line with this long-term average. So what that implies is outside of the top 10, your smaller top companies in the US are already sort of pricing in a high risk of that recessionary scenario that we painted. So although, as I mentioned, valuations are looking more attractive, the risk potentially could still lie in those company earnings expectations coming down as this macroeconomic backdrop continues to be downgraded.
Thanks, Andreea. So if we look at our portfolios today, we maintain a focus on valuation. We've got cheap assets both locally and improved valuations globally, both in equities and bonds. So for us, it's about having that long-term focus, maintaining a valuation bias in what we hold, and then having a diversified portfolio. And we've mainly done that by increasing some of our exposure to shorter dated cash instruments locally, as well as having an exposure to global cash, which has brought about good diversification benefits in the funds. So we remain committed to our process, to the way we do things, and in the long term we believe that valuation bias will ultimately add value for clients. Andreea and Izak, thank you for joining us today and sharing the insights both from a macro and a bottom-up point of view. So I think for clients that are watching today, there appears to be a lot to be concerned about. There's a lot of uncertainty in terms of the global macro outlook, but at the same time, valuations in asset classes have adjusted to reflect a lot of that uncertainty. So from an investment point of view, what we always come back to is the fundamentals of our philosophy. It's about having a valuation focus. And in a lot of the asset classes we're investing in today, you do have that valuation underpin. That value might not play out immediately, but you do have a margin of safety. And then it's about having a long-term focus. As I said, we don't know when that value will be unlocked and how things will play out, but staying committed to valuation and a long-term focus, and then having a diversified portfolio is generally what protects and enhances value over the long term. So we have aimed through the course of this year to increase the diversification in our portfolio. We've reduced our equity exposure slightly, increased our exposure to shorter dated fixed income instruments within our market. And during the course of this year, when the rand was stronger, we also increased our exposure to global cash, which has acted as a very good diversifier in our portfolios during this quarter in particular. So it's about sticking to those fundamentals and riding through the volatility and uncertainty that we currently face. So thank you very much for joining us today, and we look forward to speaking again at the end of the year.